Welcome to Talk Tickers.
Glad to be here for this one.
Yeah. If you are a regular listener to our deep dives, you probably know the drill by now. Usually, we are wading through the absolute weeds of a quarterly earnings call.
Right, dissecting EBITDA adjustments.
Exactly. Or maybe we're arguing about the valuation multiples of some mid-cap semiconductor company. We really pride ourselves on being the professional's digest for the stock market.
Taking all the noise of Wall Street and distilling it down to the actual signal.
That is the mission. But today's going to be a little bit different.
Very different, I would say.
Yeah, we are stepping entirely away from the standard equity earnings calendar. We're moving into a corner of the capital markets that is sophisticated and incredibly niche and, frankly, just fascinating.
It really is. It's a place where high finance intersects directly with catastrophic global events.
Right. We're talking about where Wall Street essentially shakes hands with Mother Nature.
And occasionally gets punched in the face by her.
Yeah, that too. So today we are conducting a deep dive into the world of Insurance-Linked Securities, or ILS.
This is a market that has grown from effectively zero, a completely non-existent asset class, to a multi-billion-dollar pillar of the global financial system.
And it's basically the invisible machinery that keeps the insurance industry solvent when the absolute worst happens.
Right, when traditional mechanisms just fail.
And the reason we are covering this on Talk Tickers today, and why you as a sophisticated investor or just a curious learner really need to understand this, is because for a lot of institutional players, this is the holy grail.
I'd say it's the holy grail of diversification.
Totally. There was a phrase in the research stack to this deep dive that just kept jumping out at me.
Was it the one about recessions?
Yeah, the exact quote was, "No recession ever caused an earthquake."
That is the entire thesis right there.
It's the bumper sticker for this entire asset class. We are talking about an investment that is fundamentally uncorrelated with the stock market.
Completely detached from it.
Right? You can have a massive financial crisis, you can have a tech bubble burst, or an oil price shock, or a geopolitical meltdown, and none of that changes the wind speed of a hurricane in the Atlantic.
Precisely. If you are holding a standard portfolio of stocks and bonds, they often move together during a crisis.
Everything goes down at once.
Yeah, we call that correlation, approach is one. But a tectonic plate shifting off the coast of Japan, it doesn't care about the Federal Reserve's interest rate policy.
It has no idea what Jerome Powell is doing.
Exactly. It is truly independent.
So before we get into the actual weeds, and we are going to get deep into the weeds today, we're going to talk about cat bonds and sidecars and trapped capital. Let's just set the stage a bit.
Give the high-level view.
Yeah. What is the actual definition here? What are we talking about when we say insurance-linked securities?
So at its simplest level, ILS is a suite of financial instruments that transfer insurance risk, specifically catastrophe risk, from insurers to capital market investors.
Okay, so normally an insurance company collects premiums. Like I pay my provider to insure my house. They collect that cash.
Right.
And if my house burns down, they pay me. If a massive hurricane hits, they pay a whole lot of people.
And if they run out of money doing that, they usually go to a reinsurer.
Which is like a wholesaler of insurance, right?
Exactly. Reinsurers are the traditional backstop. But here is the major problem. The world is getting significantly more expensive and disasters are getting bigger.
The losses are just compounding.
Yeah, sometimes the reinsurance market just isn't deep enough to handle the hit.
So ILS fits in by basically bypassing the reinsurer.
In a way, yes. Or at least supplementing them. ILS allows an insurance company, the sponsor as they're called, to bypass the traditional balance sheet of a reinsurance company and go directly to the capital markets.
And they package that risk into a security.
Usually a bond, and they sell it straight to investors.
So investors are effectively acting as the insurance company in this scenario.
They are providing the core capital. If the disaster happens, the investors lose their principal. That money goes straight to pay the claims.
But if it doesn't happen...
If the disaster does not happen, the investors get all their money back, plus a very, very healthy interest rate.
So it's a binary bet.
Or at least a very sharp one, yes.
And for the sponsors, the insurers, it's really about survival.
Yeah.
It allows them to handle massive systemic shocks.
We are talking about events that could wipe out a traditional balance sheet overnight. Hurricanes, earthquakes, and as we'll discuss later on, things like cyberattacks and pandemics.
It's just a fascinating trade-off. You are selling raw risk to people who are incredibly hungry for yield.
That's the core dynamic.
But let's rewind a bit. Let's look at the origin story here, because this isn't something that has existed for hundreds of years, right? Like standard insurance has.
No, it is relatively new in the grand scheme of finance. To really understand why this exists, we have to go back to the 1980s and early 90s.
When the insurance world was just getting hammered.
Absolutely battered. The research mentioned Hurricane Hugo in '89 as an early shock.
But Hugo wasn't the main catalyst.
Right? Hugo was bad, but the real game changer, the event that absolutely terrified the industry, was Hurricane Andrew in 1992.
I remember reading about Andrew in the notes. It hit Florida hard.
It was a Category 5. It caused absolute chaos.
And it wasn't just physical chaos, right?
It caused financial carnage. Because before Andrew, the computer models that insurers used were, let's just call them optimistic.
They didn't think it could get that bad.
They vastly underestimated the potential damage of a direct hit on a highly populated area. Andrew tore right through Florida and caused about $27 billion in damages.
And that's in 1992 dollars.
Exactly. Adjusted for today, it's astronomical.
And the insurance companies just couldn't pay.
Many couldn't. It drained traditional reinsurance capital almost immediately. Several insurance companies actually went insolvent.
They just completely collapsed.
Yeah, it was a wake-up call of epic proportions for the entire industry.
So the regulators had to step in at that point.
Regulators and rating agencies both. They looked at the books and said, this cannot happen again. You do not have enough capital to pay for the next big one.
They basically forced their hand.
They demanded that insurers find new ways to transfer risk because they realized that the balance sheets of reinsurance companies, even the massive ones like Swiss Re and Munich Re, were finite.
But the capital markets,
Right.
the stock and bond markets,
We're effectively infinite.
Yeah.
We're talking trillions of dollars floating around the global capital markets. So the idea was, why not tap into that pool?
necessity really was the mother of invention here.
Exactly right. The London market started tinkering with this in the late 80s, creating the first industry loss warranties, or ILWs.
But it was after Andrew that it really took off.
Yeah, in the mid-90s, the major players companies like AIG, Hanover Re, USAA, they began really securitizing this risk. That is when the modern ILS market was truly born.
And looking at the data we have, the growth since then has just been relentless.
It has been a very steady upward climb. From a zero base in the 90s, the market hit roughly $100 billion in total alternative capital by 2018.
That's a massive jump.
And as of early 2025, just the non-life capacity, so excluding the life insurance side, just the property side, was sitting at around $49.1 billion in outstanding catastrophe bonds alone.
That is a significant chunk of change.
Yeah.
But what is incredible to me is the resilience of that growth.
What do you mean?
Well, the sources highlight that this market grew right through the 2008 financial crisis, the 2011 sovereign debt crisis, and the pandemic.
Well, if you think back to the investment thesis, it makes sense. In 2008, the world felt like it was ending. Lehman Brothers collapsed.
The S&P 500 was an absolute freefall.
Real estate was toxic. Credit spreads blew out to historic levels.
Everything was correlated to the downside. Liquidity just dried up everywhere.
Everywhere except here in the ILS market. If you look at the Swiss Recap Bond Index between 2008 and 2018, it delivered an annualized return exceeding 7%.
So while your standard 401k was melting down, cat bonds were just quietly ticking along, paying their coupons.
Because there wasn't a major hurricane in 2008 that triggered them.
The financial mechanism held up.
The legal structure held up. Investors realized, wait a minute, this actually works exactly as advertised. It was the ultimate proof of concept during the ultimate stress test.
There is also an ESG angle here that I think is really worth mentioning for you out there listening who track environmental and social governance.
It's a surprisingly strong angle.
Right, because usually when we talk about ESG, we're talking about green energy or board diversity metrics. How does betting on a natural disaster fit into ESG?
It is a nuanced argument, but a very strong one. It's fundamentally about social resilience. By investing in these bonds, you are effectively providing the liquidity that societies desperately need to rebuild after a catastrophe.
So when the bond triggers that cash, goes to the insurer who then pays the homeowners to rebuild their roofs and their lives.
Correct. You are financing the recovery from severe climate disasters. Without this, capital insurance premiums might be so high that literally nobody could afford to live in Florida or California.
Or the insurers would just pull out entirely, which we're already seeing hints of in certain markets.
Exactly. So institutional investors view it as providing a highly necessary social safety net.
You are the financial backstop for the entire coastline. Okay, I buy the why. I understand the history and the motivation. Now I want to get into the how.
The plumbing of the market.
Exactly, because the plumbing of this is really specific. The sources highlight the catastrophe bond, or CAT bond, as the flagship instrument here.
The CAT bond is definitely the rock star of the ILS world. It is a Rule 144A security.
Let's just pause on Rule 144A for our listeners who aren't deep in the weeds of securities law. This means it is not something you can just pull up and buy in your retail brokerage app, right?
Correct. Rule 144A means these are strictly private placements for qualified institutional buyers, or QIBs.
So we're talking about the heavyweights.
Pension funds, sovereign wealth funds, specialized hedge funds. You typically need at least $100 million in investable assets to even knock on the door and participate.
Okay, so the big boys are playing. How does the bond actually work mechanically? I'm an insurance company. I'm terrified of a hurricane wiping me out. Walk me through the steps.
Okay, let's say you are a large insurance company. You know that if a Category 5 hurricane hits Miami, you are going to face $10 billion in claims.
And I don't want to hold all that risk on my own balance sheet.
Right, so you decide to issue a CAT bond to offload some of it.
Do I issue it directly like I would a standard corporate bond?
No, and this is the most critical structural detail of the whole asset class. You set up a special purpose vehicle, or SPV. Sometimes it's called a special purpose reinsurance vehicle, SPRV.
So this is a separate legal entity, basically a shell company.
It is a dedicated legal entity, usually domiciled in a place like Bermuda, the Cayman Islands, or increasingly we're seeing them in Singapore or London. And the key phrase here, the magic words are bankruptcy remote.
Bankruptcy remote. That sounds highly important.
It is absolutely vital. It means that the SPV is completely separate legally from the insurance company that set it up.
So if the insurance company goes bust because of bad management or unrelated lawsuits or a stock market crash, the money in the SPV is safe.
Exactly. The investors do not lose their money just because the sponsor goes bankrupt. They only lose it if the specific trigger event like the hurricane actually happens.
Okay, that strongly protects the investor. So the SPV issues the notes to the investors. The investors send their cash, let's say $100 million. Where exactly does that cash sit?
It goes straight into a collateral trust.
And what does the trust do with it? Just hold it in cash?
No, it invests it in high-quality, ultra-safe assets, typically short-term U.S. Treasury money market funds. So the money is just sitting there safe and sound, earning the risk-free rate.
So if I am the investor, I am earning the yield on those treasuries.
Right. But obviously that is not enough to make you take on the risk of a massive hurricane wiping out your principal.
Right. I can get the risk-free rate without the hurricane risk.
Exactly. So the insurance company, the sponsor, also pays a premium to the SPV.
Just like I pay a monthly premium for my car insurance.
Exactly the same concept. And the SPV passes that premium straight on to you, the investor. So your total return is the interest from the treasuries plus the premium from the insurer.
That perfectly explains the high yield. You are stacking two distinct income streams on top of each other.
Correct. That is why these bonds often yield 6%, 7%, sometimes 10% or more above the risk-free rate.
Okay, so the money is locked in the box. Everyone is happy. I'm getting my coupons every quarter. Then a hurricane forms off the coast.
The hurricane forms. If it hits, and if it meets the very specific criteria of the trigger, which we will get to in a second, the money is taken out of that collateral trust.
And it's given to the insurer.
Yes. The SPV transfers the cash to the sponsor so they can pay their claims. You, the investor, stop getting your coupons immediately, and you lose your principal. The bond is officially exhausted.
And if the hurricane misses entirely, or if it's just a weak tropical storm?
Then the bond matures. Usually these have a lifespan of 3 to 5 years, and the collateral trust releases your full principal back to you.
It sounds incredibly binary.
It is very binary. It is totally distinct from traditional corporate credit risk, where a company might kind of struggle or restructure. Here, the wind blew hard enough or it didn't.
But the wind blew was a bit vague for a highly complex financial contract worth hundreds of millions of dollars.
Very true.
Which means we need to talk about the trigger. The research repeatedly emphasizes that the trigger is the single most important part of the entire deal.
The trigger dictates the entire risk profile. It is the absolute rule book for when the money moves. And let me tell you, there are heated debates in the industry about which trigger is best.
Well, let's break them down for the listeners. The sources mentioned indemnity triggers are the most common. Roughly 2/3 of the market uses them.
Yes, typically between 66% and 73% of the total issuance uses indemnity triggers. An indemnity trigger is based on the actual financial losses the insurer suffered.
So if Allstate says we tallied up all the claims from our thousands of adjusters and we officially lost $1.5 billion and the bond trigger starts at $1 billion, then the bond pays out.
Exactly. It perfectly mimics the insurer's actual pain experience.
Yeah, that seems the most logical for the insurer. They get paid exactly when they bleed.
It is considered the gold standard for the sponsor because it completely eliminates basis risk.
Let's define basis risk for our listeners, because that term comes up a lot.
Basis risk is the mismatch between the payout of the financial instrument and the actual physical loss you suffered.
So if you lose $1 billion, but your insurance or your bond only pays you $100 million, you have massive basis risk.
Right. With an indemnity trigger, the payout is explicitly tied to your actual reported loss, so basis risk is near zero.
But if I am an investor buying this bond, do I actually like this setup?
Not really. For an investor, indemnity triggers are a complete black box.
Because I have to inherently trust Allstate's math.
You have to trust their underwriting standards, their claims handling process, their lawyers. And it takes a very long time. It can take months or even years to tally up the final losses from a massive catastrophic event.
So my money is just sitting there and I don't know if I've lost it or not.
Exactly. Investors heavily prefer clarity and speed, which brings us to the second major type, parametric triggers.
Now, this is the stuff that sounds like pure science fiction to me.
Parametric triggers are the absolute darling of the pure capital markets. They detach the payout entirely from the financial loss and attach it directly to the physics of the event itself.
So it's not about dollars lost, it's about actual wind speed.
Wind speed, earthquake, magnitude, barometric pressure. It is purely objective data.
The cat and circle example from the notes, so let's walk through that because it's a perfect illustration.
Okay, imagine a digital map of Florida. You draw a precise geographic circle around Miami. The legal contract says if a hurricane passes through this specific circle with a central pressure below 940 millibars, the bond pays out 100%.
And it literally doesn't matter if the hurricane hits an empty swamp or a crowded skyscraper.
Completely irrelevant. It doesn't matter if the insurer lost $10 billion or $10. If the physical conditions are met, the money moves.
That is incredibly transparent.
And incredibly fast. You can settle a parametric bond in weeks, sometimes literally days. There are no claims adjusters to argue with. It is just raw data pulled from the National Hurricane Center or the USGS.
But this brings basis risk roaring back into the picture for the insurer, right?
Huge basis risk. Imagine the hurricane wobbles just slightly. It misses the digital circle by 5 miles, but the wind field is absolutely massive, and it destroys Miami anyway.
Oh, wow. So the insurer gets nothing from the bond because the storm didn't cross the mathematical line.
That is a nightmare scenario for a CFO. You paid the hefty premiums on the bond for years, the disaster actually happened, your company is bleeding cash, and you get zero from the bond.
That is the ultimate trade-off. Speed and transparency for the investor versus accuracy of coverage for the sponsor.
There are also industry loss indices where the payout is based on total industry-wide losses reported by a third party like PCS or perils.
And model loss triggers too, where they run the physical data through a pre-agreed computer model to determine the payout.
Yes, but parametric is the most stark contrast to indemnity.
There was a really specific example in the research that I want to highlight, the Mexico multi-cat bond. This honestly reads like a financial suspense thriller.
It's a classic case study in the parametric world. This was Mexico Multicat 2012-1. It was a bond issued to protect Fonden, which is Mexico's government-run natural disasters fund.
Okay, so the Mexican government is essentially the sponsor here.
Right. They issued different tranches or slices of risk. Class B specifically covered Atlantic hurricanes hitting the coast. And it utilized a parametric trigger based on barometric pressure.
Pressure is a better measure than wind speed, right? Because wind speed fluctuates constantly, but pressure is a steady indicator of the storm's intensity.
Exactly. The trigger condition was that the central pressure of the storm had to drop below 920 millibars within a specific designated geographic zone off the coast.
And 920 millibars is roughly equivalent to a strong Category 4 or Category 5 storm.
Very severe. So imagine you are the investor. You have millions of dollars sitting in this bond. A massive hurricane is approaching Mexico. You are literally sitting at your desk, refreshing the NOAA website, watching the live millibar reading.
It is a totally binary outcome.
If the pressure drops to 919 millibars inside that zone, you lose 50% or 100% of your principal instantly. That money immediately goes to Mexico. If it stays at 921 millibars, you keep your money.
2 millibars. That is a razor-thin margin for millions of dollars.
It led to a lot of controversy, actually. There was a storm, Hurricane Odile, later on, where there were intense arguments about the exact pressure reading.
Like, did the reconnaissance plane measure it correctly? Was it exactly in the zone?
Yes. It perfectly highlights that even with objective scientific data, there's always room for a little drama when that much money is on the line.
High-stakes weather watching. Absolutely love it. Okay, so that's the cat bond. That's the big, formal 144A security. But the toolkit for this market is bigger than just that. The sources mention sidecars and ILWs. Let's talk about sidecars first.
A reinsurance sidecar.
Is this literally like a motorcycle sidecar?
The analogy holds up surprisingly well, actually. If the reinsurer, say Munich Re, is the motorcycle driving the main business, the sidecar is a passenger attached to the side sharing the exact same ride.
And sharing the exact same risk.
Exactly. A sidecar is a financial structure, usually a limited duration vehicle, that allows third-party investors to take a quota share of a reinsurer's book of business.
Quota share meaning they just take a flat percentage of everything.
Typically, yes. Unlike a cat bond, which is usually for a specific peril like Florida wind, a sidecar often covers a vertical slice of the entire portfolio.
So if the reinsurer writes policies for hurricanes, earthquakes, Japanese typhoons, and marine liability,
the sidecar investor takes, say, 20% of the premiums and pays 20% of the claims for all of that combined.
why do reinsurers do this, though? Why would they share those lucrative premiums?
Usually it's to handle peak risks or to capitalize on what we call a hard market.
A hard market being when insurance prices are exceptionally high.
Right. Imagine prices for insurance skyrocket because there haven't been many providers or there is just a bad string of losses. The reinsurer wants to write as much business as possible to capture those high rates.
But they are strictly limited by their own internal capital reserves and regulatory requirements.
So they bring in a partner, they set up a sidecar, they tell investors, hey, look at these incredibly high premiums. You put up the capital, you take 20% of the risk and reward, we take 80%.
It allows the reinsurer to basically punch above its weight class without permanently straining its own balance sheet.
And for the investor, it's a great way to access the deep underwriting expertise of the reinsurer. You don't have to hire a team to underwrite the risk yourself. You just blindly ride along with Munich Re.
But it's often described as mercenary capital. Right.
Very much so. Sidecars are often temporary, usually lasting just 1 to 3 years. Investors aggressively pile in when rates are high and they leave the second rates drop.
Highly tactical.
Completely tactical, fully collateralized, and short-term.
Okay, moving on to ILWs, industry loss warranties. The name sounds incredibly dry, but the underlying mechanism is fascinating.
An ILW is effectively a pure derivative contract. It's a bet on the total industry-wide loss.
So not how much did Allstate lose, but how much did the entire insurance industry lose as a whole?
Correct. It's triggered by aggregated data from a third party like PCS. A contract might plainly state if the total insurance industry losses from a single U.S. wind event exceed $50 billion, this contract pays out.
Who typically buys these?
Usually reinsurers or specialized hedge funds looking to broadly hedge their portfolios. It's a blunt instrument. If you think a $15 billion industry event will likely hurt your specific portfolio, you buy an ILW that pays you if that exact event happens.
This is where I saw the terms live cat and dead cat trading in the notes. Now, on Wall Street, a dead cat bounce is when a bad stock recovers slightly before falling again. But this means something totally different in the ILS world.
Very different. Live cat trading is literally trading these derivative contracts while the catastrophe is actively unfolding.
Wait, so the hurricane is actively in the Gulf of Mexico spinning directly toward New Orleans, and people are on trading desks buying and selling these contracts.
Yes, it is incredibly volatile. Imagine trying to price a financial contract when a Category 4 storm is wobbling in real time.
Right, because if the forecast track shifts just 50 miles west, the potential industry loss might jump from 10 billion to 50 billion in an hour.
Exactly, and the price of the ILW swings wildly with every forecast update.
It's literally real-time arbitrage of human destruction.
It is. Traders are intensely watching the weather models, the satellite feeds the pressure readings, and buying or selling financial protection based on exactly where they think the storm will make landfall.
And dead cat?
Dead cat trading happens after the event has already occurred, but before the final loss total is completely known.
Because the damage tally isn't instantaneous.
Right. The hurricane has hit. We know for a fact New Orleans is flooded. But is the total industry loss 30 billion, 40 billion, 60 billion? Nobody knows yet.
So investors trade on that specific uncertainty.
You might hold a contract that triggers exactly at 40 billion. If the early models estimate 35 billion, you might sell that contract in a panic for pennies on the dollar.
But if the estimates slowly creep up to 39 billion over the next week, that same contract suddenly becomes massively valuable. you are betting on the final bill. It is genuinely fascinating how they have financialized every single millisecond of a disaster, before the storm, during the storm, and after the storm.
It's the ultimate expression of risk transfer. If there's any uncertainty, Wall Street will find a highly efficient way to price it.
There is one more tool in the toolkit I want to touch on briefly: contingent capital, or as the notes call them, catastrophe equity puts.
This is the break glass in case of emergency option for an insurer.
How does it work mechanically?
It's basically a put option. It gives an insurance company the contractual right to sell its own newly issued stock to investors at a pre-agreed price if a catastrophe occurs.
Why would they need to do that?
Think about what happens to an insurer's stock price immediately after a massive disaster. It crashes, right?
Sure, shareholders panic and sell.
But that moment is exactly when the company desperately needs fresh cash the most to pay out claims. If they tried to raise money by selling stock in the open market the day after a disaster, they would get crushed.
They'd be selling at the absolute bottom, diluting their existing shareholders massively.
So the equity put guarantees them a willing buyer at a fixed floor price.
It's brilliant.
Yes, it usually has a dual trigger. It requires both a significant drop in the stock price and a major catastrophe event to activate. It ensures critical liquidity right when the company is bleeding. It's a safety net for the balance sheet.
Okay, so we've covered the classic hits of ILS, wind and earth, hurricanes and earthquakes, but the sources strongly highlight new frontiers. The market is aggressively trying to expand beyond just natural disasters. The two big ones mentioned are cyber and life ILS. Let's start with cyber.
Cyber is the absolute sleeping giant of the insurance industry. Everyone knows the tremendous risk is there. Ransomware data breaches, global cloud outages. The corporate demand for cyber insurance is absolutely exploding.
But traditional insurance companies are terrified of cyber, aren't they? They don't want to write blank checks for hackers.
They are deeply cautious because of what we call accumulation risk.
Explain that concept for us.
In the natural catastrophe world, events are usually localized geographically. A hurricane destroying Florida does not cause an earthquake in Tokyo. They are completely independent events. You can diversify your portfolio easily.
But you balance your Florida risk with your Japan risk.
Yeah.
But in cyber,
everything is globally connected. If there is a fundamental vulnerability in Microsoft Windows or a major cloud provider like AWS goes down, that hits everyone simultaneously, worldwide.
We actually saw a preview of this with the CrowdStrike event recently. One single bad software update and airports, banks, and hospitals all over the entire world just stopped working instantly.
Exactly. That is the nightmare of accumulation risk. It's a massive systemic shock. Traditional insurers simply do not have the balance sheet capacity to cover the entire digitized world going offline all at once. It could easily be $1 trillion loss event.
So they need the massive scale of the capital markets to backstop them.
They desperately need the depth of the bond market, and we are finally seeing the first Rule 144A cyber cat bonds being successfully issued. The sources specifically mention pioneering deals like Polestar Re, Long Walk Re, and Matterhorn Re.
How do they even price these, though? We have literally hundreds of years of detailed hurricane data to build models on. We don't have hundreds of years of global cloud outage data.
That is the defining problem of the sector. Modeling risk is monumental here. We have maybe 2 decades of truly relevant data, and the threat landscape mutates every single week.
A hurricane doesn't actively learn from your defenses.
Exactly. A hurricane doesn't try to evade your firewall. Hackers do. It's an adversarial risk.
So investors must demand a massive premium to take that on.
A huge one. These bonds are currently pricing similar to peak U.S. catastrophe risks, very high spreads. Investors are essentially saying, if you want me to take this blind, unmodeled risk, you have to pay me handsomely for it.
But the ultimate goal is to move that catastrophic tail risk off the insurer's balance sheets so they can write more standard policies.
Yeah. Yes. If the capital markets can eventually get comfortable with cyber, the sheer size of the market could eventually dwarf the property catastrophe market. But we are very much in the early innings.
Now let's pivot to life ILS. I have to say, reading the term life ILS, it sounds a bit clinical. Are these essentially death bonds?
The industry tries very, very hard to avoid that specific term, but yes, extreme mortality bonds do exist.
How do those work in practice?
They serve as a massive hedge for life insurers. If a global pandemic hits, like COVID-19, and sadly kills a significant percentage of the global population, Life insurers suddenly have to pay out massive death benefits all at once.
Which could bankrupt them.
Right. So an extreme mortality bond pays the insurer an injection of cash if national mortality rates jump sharply above a certain predefined index.
So it's a pure pandemic hedge.
Yes. But the life ILS market is actually much broader and more complex than just that. It also, importantly, covers longevity risk.
Which is the exact opposite problem, right?
Exactly. The risk that people live too long. If you manage a massive pension fund or you are an annuity provider, your absolute worst financial nightmare is everyone living to be 110 years old.
Because you literally run out of money paying them every month.
Exactly. You can actually securitize that longevity risk and sell it to capital market investors who are willing to bet against extending life expectancy.
That is wild. But there was another fascinating part of life ILS mentioned in the notes that I really want to dig into. VIF securitization. Value of in-force. This sounds like pure hardcore financial engineering.
It is complex financial engineering, but the underlying logic makes perfect sense. Imagine you are a large life insurer. You have just successfully sold thousands of 30-year life insurance policies.
Yeah.
You know that statistically speaking, these people will reliably pay their premiums for the next 20 to 30 years.
So you have a highly predictable stream of future cash flow locked in.
Right. But that profit is strictly in the future. You can't spend it today to grow your business. It is considered an illiquid asset trapped on your current balance sheet.
So VIF lets you somehow unlock it.
Exactly. You formally package those highly predictable future profits into a new security. Institutional investors pay you a large lump sum of cash today.
And in exchange,
the investors get the legal right to receive those future profits as they slowly come in over the next 20 years.
it's exactly like a modern SaaS company, factoring its monthly subscription revenue to get upfront capital.
That is a brilliant analogy, actually.
Yep.
Yes. It allows the insurer to formally monetize future profits, to raise hard cash right now, maybe to pay special dividends, or to underwrite new business, or to acquire a vulnerable competitor.
And who is actually buying these? Who wants to wait 20 years for a slow trickle of life insurance premiums?
Pension funds, mostly. They have extremely long-term liabilities. They have to reliably pay their retirees for decades into the future. So they absolutely love assets that have incredibly long duration and very stable, predictable yield profiles.
It perfectly matches their liability duration.
Exactly. So it's a highly sophisticated matchmaking service between insurers who desperately need cash now and pension funds who desperately need reliable cash later.
Precisely. Okay, we've painted a pretty rosy picture so far of this whole industry. High yields, uncorrelated returns, essentially helping the world rebuild clever financial engineering. But we are talk tickers. We're deeply cynical by nature. We have to look at the downside. What can actually go wrong here?
A whole lot can go wrong. And it is not just the obvious primary risk. The obvious risk is the massive hurricane hits and I lose my entire principal. That is just the risk you willingly signed up for.
That's just the beta of the asset class.
Right. But the structural risks, the hidden plumbing problems, are what actually keep portfolio managers sweating at night.
We mentioned basis risk earlier. The agonizing risk that the physical trigger simply doesn't perfectly match the financial loss.
That is a constant underlying tension in the market. Investors constantly push for parametric triggers because they are totally clean and fast. Sponsors forcefully push for indemnity because they want perfect financial coverage. The market is constantly aggressively negotiating this trade-off on every deal.
But there is another specific risk that really stood out to me in the research notes: trapped capital. This sounds like an absolute nightmare for an institutional investor.
It is widely considered the biggest single friction point in the entire market right now.
Walk us through a specific scenario of how capital gets trapped.
Okay, imagine you manage a hedge fund. You invested $50 million in a standard cat bond. It is a 3-year duration bond. It is legally scheduled to mature and pay out on December 31st.
Oh.
You are fully expecting your $50 million cash back on that date so you can reallocate it to a new investment or pay redemptions to your own investors.
Great standard bond mechanics.
Then in late October, just 2 months before the final maturity, a messy hurricane strikes.
What do you mean messy?
I mean, it causes widespread damage. But the early loss estimates are highly conflicting. It's not immediately clear if the total industry loss breaches the specific attachment point of your bond.
The loss estimates are just fuzzy and debated.
Right. So the sponsor, the insurance company, invokes a clause and says, hey, we very well might have a loss here that triggers your bond. We just don't know the final math yet. So per the contract, we are officially going to extend the maturity of the bond.
They unilaterally freeze the collateral.
They totally lock it down. They sweep your $50 million into what is legally called a side pocket.
A side buckle.
Yes, it is segregated. You still technically, theoretically own it on paper, but you cannot touch it. You cannot withdraw it. You cannot reinvest it in a higher yielding asset. It just sits there frozen while the competing lawyers and claims adjusters fight over the final tally.
For how long are we talking?
Months, very often years.
Years. You're trapped for years.
Just look at Hurricane Ian in 2022. Or the massive wave of COVID-19 business interruption disputes. Billions of dollars of capital was fiercely trapped for a very, very long time.
That absolutely kills your fund's liquidity.
It completely destroys it. And think about the massive opportunity cost. If broader interest rates are rapidly rising, like they have been recently, and your $50 million is stubbornly stuck in a side pocket, earning a very low historical rate, you are bleeding opportunity.
It's just dead money.
It effectively is dead money. And this understandably deeply frustrates investors. Unlike the traditional reinsurance market, which is fundamentally a relationship business, I'll stick with you through the bad times if you stick with me through the good times. Capital market investors are pure mercenaries.
They have absolutely no inherent loyalty to the insurer.
None whatsoever. If they get badly burned by trapped capital, or if the relative yields in corporate credit suddenly become more attractive, they just leave. They take their remaining capital and aggressively exit the asset class.
Which immediately creates profound liquidity risk for the sponsors who rely on them. They might build their whole business model assuming this capital is there, and suddenly it completely vanishes.
Exactly. It's hot money, and it acts like hot money.
There is also the glaring issue of modeling risk. We touched on this briefly with cyber, but it heavily applies to the weather too, doesn't it? Mm-hmm. We are putting an awful lot of blind faith in computer algorithms.
We are. The entire multi-billion-dollar market relies heavily on a few third-party risk models, firms like RMS ARR, which is now Verisk, and CyberCube for cyber.
And these models run simulations of like 10,000 years of hypothetical weather, right?
Yeah. They run massive stochastic simulations. What if a Category 4 hits exactly here? What if a fault line ruptures exactly there? But at the end of the day, models are entirely based on human assumptions. And as the famous saying goes, all models are wrong, some are useful.
And with climate change accelerating.
That is the massive elephant sitting in the room. The historical weather data from the past century might no longer be a reliable predictor of the future. If the models are deeply calibrated on the last 100 years of stable weather, but the underlying climate has fundamentally shifted, the models might be wildly underpricing the true current risk.
So what used to be a 1 in 100-year storm might actually realistically be a 1 in 20-year storm now.
Exactly. And if sophisticated investors start to feel that the underlying models are fundamentally flawed, they will demand significantly higher yields to compensate for that uncertainty, or they will just completely stop buying the bonds.
It triggers a crisis of confidence in the underlying math itself.
It absolutely does, and that threatens the whole ecosystem.
So we have extensively covered the history, the complex mechanics, the exciting new frontiers, and the severe structural risks. Let's try to actively bring this all together for our audience. What is the single big takeaway for our listeners today?
I think the key takeaway you need to internalize is that ILS has successfully transformed raw insurance risk into a highly mature investable asset class. It is no longer just a quirky niche experiment from the 90s.
It is a roughly $100 billion market that acts as an essential load-bearing pillar of the global financial system.
It provides the vital capacity the world desperately needs to handle peak perils. Without this specific market, insurance for a Florida hurricane or a California earthquake might simply be financially unaffordable for the average person or entirely unavailable at any price.
Correct. We absolutely need this massive pool of capital just to physically rebuild our cities. And for the investors listening, it offers that incredibly rare, holy grail, true structural diversification. A legitimate way to escape the relentless correlation of the broader stock market.
But it strongly requires intense homework.
It's definitely not a passive set it and forget it index fund investment.
Definitely not. You need to deeply understand the trigger mechanisms, you need to understand the agonizing risk of side pockets, and you need to critically evaluate the risk models.
I want to leave our listeners with a final thought that really struck me while I was reading through the source material about the exponential growth of this market. As climate change potentially rapidly increases the frequency and severity of these massive physical disasters, and as our increasingly digital world inevitably creates these new unseen cyber hurricanes, our global reliance on ILS is only going to grow.
I completely agree. The underlying demand for this capital will be truly insatiable. The world is objectively getting riskier, not safer.
But here is the lingering question, and I really want to play devil's advocate here to close us out. Does this intense financialization of disaster, does mathematically turning a hurricane's destruction into a high-yield bond, does it inherently distance us from the devastating human cost?
That is a very deep philosophical question.
If we make it financially efficient to actively bet on disasters, do we subtly stop caring about actually preventing them? If a wealthy hedge fund manager sitting safely in Connecticut is actively cheering for a massive hurricane to miss a digital circle by exactly 5 miles just so he keeps his 10% yield, does that create a strange societal moral hazard?
It definitely feels uncomfortable.
Or conversely, does the fact that absolutely everything is neatly insured encourage us to just keep recklessly building luxury condos in known flood zones because, hey, the capital markets will always pay for it to be rebuilt?
It is the classic profound moral hazard argument. Does the existence of seamless insurance secretly encourage incredibly risky societal behavior? Perhaps it does. But I would strongly argue the realistic alternative is significantly worse.
Which is what exactly?
A world where we simply cannot afford to rebuild it all. Empathy is obviously essential. We desperately need to care about the people suffering on the ground after a storm. But raw empathy doesn't pay for millions of tons of lumber.
Yeah.
Empathy doesn't physically pay for concrete. Empathy fundamentally doesn't restart a destroyed power grid. Hard liquidity does.
Empathy doesn't pay for concrete. That is a very cold, very hard truth to end on.
It's cold, but it is true. Financial engineering, for all of its obvious inherent flaws and coldness, is effectively the only way we can pool enough global resources to practically handle the staggering scale of destruction we are currently facing in the 21st century.
It is a totally necessary utility, a mercenary one perhaps, but absolutely necessary for civilization to function.
I firmly believe so, yes.
Well, on that deeply cheery note, I want to say thank you for thoroughly unpacking this with me today. This has been a genuinely fascinating look under the hood of the global risk market.
It was my pleasure entirely. It is always incredibly fun to explore these hidden fringes of finance with you.
And to our listeners, thank you so much for joining us on this extensive deep dive. Hopefully, the very next time you see a news report about a hurricane forming, you will briefly think about the massive, invisible web of capital that is quietly waiting to catch the fall. We will see you next time on Talk Tickers.